When we're talking about 100 billion, hundreds of billions, specifically $300 billion, that's your estimate for how much could be vulnerable to rising rates. So in which ETFs are we talking about that could be hardest hit?
Right. So you look, there's several categories whose whole being and assets were basically built on the back of low rates. This huge thirst for yield has been a trend for about 10 years. You got junk bond ETFs with 60 billion, dividend stock ETFs have 160 billion, REIT ETFs have 60 billion, MLPs have 20 billion. Then you got a sort of variety of multi-asset income, covered call strategies, mortgage REITs. Those have another 10. A lot of that's going to stick. We've seen some other examples of rate rising in the past 8 years to study this. Some's going to stick, but some will leave. The question is how much above 3% does it go? Because some of the spreads on these aren't that big, and you could see a lot of assets moving. And whatever happens in ETFs, you can multiply it by 2 or 3 in mutual funds.
Oh, wow.
Yeah.
Let's talk about junk bond ETFs specifically here, because, again, some of the assets might stick, as you say. And if the economy is improving, maybe we could still see some appetite for high yield. So how does that all play out?
It's possible. It depends on the spread, right? So the median yield of a junk bond ETF is 4.5%. HYG is about 5%. If you can get 3% in a treasury, there's probably some longer-term investors who will bail on that trade. The junk bond ETFs are popular trading. There's always going to be people trading them. That will give them some assets. But I do see some of the retail investors might move over because they just don't want to hold junk debt unless they really have to. And so I do see some of that money leaving.
And one of the areas that you say could be the most sticky is the dividend ETFs, high dividend ETFs. Why?
Yeah, because a couple of reasons. One, people just like stocks that pay dividends. Those are the dividend grower ETFs. I think that money's pretty much going to stick. High dividend ETFs, I think you could see some shakiness there.
Okay, gotcha. So just to make clear the distinction here, there are high dividend ETFs on the one hand, and then there are those that try to buy companies that they estimate the dividends will be growing.
No, those are companies that have increased their dividends, say, over the past 20 years.
Okay,
so you get a bunch of those old big companies, they market cap weight them. The yield on those is 2%. In other words, you're not buying that for the yield. You buy the high dividend ones for the yield. You get a lot of utilities and staples in those. Those are probably more vulnerable. The other thing is the median yield on a dividend stock ETF is 2.8%. It's already below what you can get with Treasury. So if that money hasn't moved yet, you can see a little bit, but I think those are probably the least vulnerable.